Get your pumpkin, fill up the candy bowl, and figure out your costume. It's almost Halloween. And in the spirit of Halloween, we're asking which stocks are tricks, value traps, and which ones are treats. Stocks that are buys now. Joining me now on set is Joe Magyer, Chief Investment Strategist for the Motley Advisor and Inside Value Investing Newsletters. Joe, it's great to see you. Thanks so much for coming in.
Thanks for having me.
So the first stock on the list is Amazon.com. This stock has been on a tear. It's up, what, 45% just this year alone? But it's got a nosebleed price-earnings ratio of 350. So what do you say, trick or treat?
Well, the valuation looks tricky, but I'd say it's a treat. And the reason is that Amazon has a huge first-mover advantage in online retail. In the real world of retail, you have to compete usually on price or selection. And in this case, they can actually lead on both because they were so early. So you go to Amazon.com and they've got around 15 million items. At a typical Walmart, you have 150,000. So in terms of selection, it's much larger. It's also a lot more convenient if you don't actually enjoy going to Walmart. No offense to people who do like to get out and shop, but personally, I just like to click and have things show up at my door, and it's a lot easier. And so because of that, I think people are really underestimating the durability of their competitive advantages and how long they're going to be able to keep earning at high rates for a long time.
Well, talk to me about the Kindle. A lot of people think that Kindle Fire is going to be the real driver of this company, at least in the near term. But I guess my question is, Amazon's still making these things at or below cost. So is there a point where you see them able to raise the prices on this e-reader, boost their margins? And what about the fact that you've got competition coming in here, right? Apple is rumored to be launching a mini iPad this fall.
Well, I think Amazon's taken the right strategy of going really cutthroat on pricing. And the reason is that unlike Apple that makes all their money at the point of sale, so when the hardware is actually sold, Amazon makes their money when you buy books later and other media. So it's kind of like a razor blade model where they'll happily sell you the tablet at cost today to make you a lifelong customer. And what ends up happening is you buy a Kindle, you start buying books for your library, and before you know it, you've got this huge digital library all through Amazon. And when you keep adding to books over time, just like when people got hooked onto iTunes and your music libraries, it can be a similar dynamic with books. So it's terrible for margins today, but I think over 5-10 years, it's going to be very profitable for them.
Talk to me about how much upside you see from here, from the $250, $260 level for Amazon.
I think over the next 10 years, it's reasonable to think they'll compound at something like 12-15%. Obviously not anything like they've done in the past 10 years, which is blow the lights out. I mean, the stock isn't conventionally cheap today by any means, but I do think it's a great business that'll quietly outperform.
Okay, let's move on to the next company on the list, Best Buy. You know,
the showroom.
The showroom, exactly. And in fact, this big box electronics retailer has actually been reeling because of Amazon, hasn't it?
Yeah, they're really struggling right now with the shift to digital media and online. You know, we used to go in Best Buy and you'd buy CDs, you'd buy DVDs, and now so much of that is just coming online, and Best Buy doesn't really have a competitive presence there. Making matters worse is that those items used to be their highest margin items. And TV prices have been fading over time, which is hurting their margins. And you know, unlike Amazon, which has a digital storefront and effectively can grow and shrink as much as it needs, Best Buy has these huge big box stores and they can't shrink their footprints with their sales. So they're deleveraging pretty badly, profits are going to fall off, and honestly, I don't think this is a business that's going to be around in, say, 5 to 7 years. And it's probably going to get pretty ugly on the way down.
So this is a value trap.
It's a total value trap. The only saving grace might be a buyout. And the only people who'd be interested would be the actual founder of the company who, for whatever reason, I'm thinking legacy, is thinking he can come in and turn the business around. He wants to make a go of it, but he's going to have to get a lot of private equity money to back that up. And to be honest, it would seem like a pretty dumb investment to me. I think you can lever it up some, but that's not going to fix just this tectonic shift in the way people consume media that ultimately is going to leave these guys in a terrible spot.
What about UPS? The stock's flat on the year. We're seeing growth slow domestically as well as globally. What can Brown do for investors?
Well, I think a lot, and it's funny because Brown is like almost the closet play on online shipping. So a lot of packages show up when you order from Amazon, come straight through UPS. And what I love about UPS is that the competitive advantages they have are so huge that it's incredibly difficult to break into the US market. So a good example is DHL, which is basically running from the German post office, was trying to compete in the US, fought hard for a decade, gave up and left. So it just shows how strong an advantage they have here. But not just that, I love how they're competing internationally, and they're expanding really aggressively in China, Brazil, Mexico, and what they're doing is they're extending the size of the network, and with each place that they start shipping packages to, they add value to the rest of the network. So to me, those investments aren't paying off much today, but I think over 20, 30, 40 years, it could be incredibly valuable.
40 years, Joe, that's a long time to hold a stock.
It is, but we got time, we're young.
All right, we are young, okay, but what about the fact they did or they have a proposed acquisition with a Dutch delivery company called TNT Express.
Yeah.
You know, if this acquisition goes through, that's going to give them exposure to Europe that they don't have right now.
Right.
Are you worried about that and what that can mean for the bottom line, given that Europe is dealing with some grave economic issues that are going to take time to work out?
Well, on its face, it looks terrible because Europe is doing awful and TNT is losing money. The real value is that in a network-based business like this, when you buy a bunch of trucks, shipping sites, et cetera, and you overlay them with your own network, you're able to wring out a ton of synergy from that, cut a ton of cost, and it'll consolidate the European market a little bit more, which will give them more pricing power. So even though no one else could make much money owning this company, as a part of UPS, I think it'll add a lot of long-term value.
All right, let's move on to Groupon. This stock has crashed since the IPO. And there's a consensus on Wall Street that this company does not have a sustainable competitive advantage over rivals. In fact, I think merchants are now questioning the validity of actual Groupons. But what got me thinking about this company and why I wanted to bring it up today is the foray into the mobile payments space. Do you think this is going to be a game changer for Groupon?
It could be. I think that they don't have much of an edge on coupons as much as people would like to think, but with mobile payments, they do have tons of relationships with merchants and consumers. And you know, the fees on these cards are around 2%. That's a good bit of revenue.
It's hefty for a small business, right?
Exactly. And the beauty of it is for Groupon, it's pretty capital light. So unlike if you're trying to compete with UPS, where you'd have to build up a whole fleet of trucks, in this case, you're just sending out these tiny little cards and readers that people plug into your phones. You just swipe a card. And for them, it's a great stepping stone, even though payments may not be something they've competed in before. You know, they've got all these relationships.
So would you be buying based on this, or sort of a wait and see?
Definitely wait and see. I love the promise of it, but they're also not the only ones doing it. Square was an
it's a saturated market.
Exactly.
Sorry, say again, Square?
Well, Square is out there competing. They're private, but they were kind of a first mover here. eBay is also competing in the space, so even though I think it's a great move for them, it's not one where they have a huge advantage.
All right, Joe, final question for you. It's a serious question. What are you going to be for Halloween?
I don't know yet. I went as a mortgage-backed security 2 years ago. That was probably the highlight of my Halloween. Yeah, that was the highlight of my Halloween days.
All right, Joe Magyer, thanks so much for coming in.
Thanks for having me.
So much for those stock picks.
Thanks.
All right, and that's our show. Thanks so much for tuning in. As always, you can watch us online at www.youtube.com/Wall Street Report and email us at wallstreetreportwithjen@gmail.com.